Hello everyone, how are you? I'm Dr. Labib. How are you all? Hope you are doing well. How things are going with respect to preparation for examinations? Hopefully it will work. Okay. Today, in continuation with the mock exam explanation, today we are going to have section B, financial reporting, F7. We will cover section B, 3 scenario based questions. It will be for when we are doing this, it will be for 3 scenarios will be there, isn't it? And you will have 3 sections, 5 multiple choice questions, 5 into 2, it comes to 10 marks, into 3 sections, is it right? Into 3 scenarios, right? Into 3 scenarios, it will be how many marks? It will be 30 marks. Fine. Very simple, very specific. What is the approach you have to adopt? Is that the foremost is you have to just go during the reading time, just go through the scenarios, okay, and underline the things which are important. I kindly request you to subscribe to this channel, share this channel. See, the only purpose of coming with this series for most of the subjects, F7 financial reporting, F8 audit and assurance, SBR, and hopefully next time I'm going to start F9 financial management and advanced financial management. Okay, and this channel is going to give you a good resources, practical resources, anything, any requirements, any things with specific, just post it in the comment box. I will come up with that suggestions immediately, not very soon, immediately. So my request for every one of us, you is share this channel, subscribe to this channel, and press bell icon. Is it? That's very simple. Hopefully it will give you as good returns. We will succeed. Coming back to this, with respect to section B, this is with respect to each question worth 2 marks. It will be from 16 to 25 questions. What we are saying, Telepath has a year end 30th September. Dates are very important. I repeatedly say this. Dates are very important, and owns an item of plant which is used to produce and package pharmaceuticals. What is the plant cost? Plant cost is 750 when it is the 1st October. As on that, there is an estimated useful life of how many years? 5 years. A review of plant has been done in April 1st, 2003. Means when they have said 1/10/2000, 1/10/2001, this is 1 year, this is 2nd year, isn't it? This is the 1st year, this is the 2nd year, and 1/4/2003, it is for 6 months, means 2.5 years. Okay. A review of plant on 1st April 2000 concluded that the plant will last for the how many years? Another further 3.5 years. And what is the fair value? 560. Okay, that's good. Means initial number of years are how much? Initial number of years is 5 years. Is that initial value is how much? Initial value is 750. Okay, initial value is 750. Now we will come back to the revised value. They have mentioned the revised value. Is that they have mentioned the revised value is 560 and revised number of years is 3.5 years. Telepath adopts the policy of revaluing its non-current assets to their fair value, but does not make a annual transfer from revaluation surplus to retain. They will revalue, but they will not do the transfer to the retained earnings to represent the additional depreciation. See, what is the rule of revaluation? If you are revaluing the asset, especially IAS 16, property, plant and equipment, we have to calculate depreciation on the revalued amount. That is the basic principle which we have to adopt. Okay, that is what it says. You have to have an additional depreciation. On 30th September, at the end of third year, is it right? 30th September 2003, they informed a major customer that they are no longer placing orders with Telepath. As a result, Telepath revised the estimates of cash flows. Okay, fine. They have estimated 2000, fine, to 4, 5, and they have estimated. Now, what is the cost of capital? We had the cost of capital is 10%, and they gave you the discount factors. Fine. We have to calculate the present value of cash flows. Okay. By this, we can understand what these their requirements. Now, Telepath also owns Rilda company, 100% subsidiary, which is treated as a CGU, cash generating units. Very important concept. Very important. I posted the video for cash generated units, discontinued operations. It's very important. Please revise the lecture, conceptual lectures first. You go through it, then you do the mock exam. That's what I say. Even now, you can do it, but once it's done, you can go back to the conceptual lectures. On 30th September, they have an impairment of how much? 350. The value is 3.5 millions. Okay, 3.5, 3,500,000. The carrying amount, the amount of these assets are below. Okay, goodwill. See, goodwill will be written off. First, goodwill will be written off. Fine. Next, goodwill will be written off. Then what will happen? You will have the factory building. You have the factory building. You have the plant, and you have the current assets will remain same. Okay, current assets will never change whenever we are talking about the impairment and with respect to the IAS. Now, in accordance, this is what it has been given. This is the scenario they have mentioned. Fine. Now, in accordance with the impairment of assets, 130 IAS 36. Okay, IAS 36 impairment of assets. Be very clear about these. See, we should know only the basics. Okay, the principles of the standards. Very important. How it is go. What are the basic principles? Whatever is given. See, this is the question paper given by one of the service learning providers. Is it one of the learning providers? I'm just taking this from them, and I am explaining the concepts. Fine. In accordance with IAS 36, impairment of assets, which of the following explain the impairment and assets and how we have to calculate the recoverable amount? Fine. Now, what is very, very simple? I will put it this: as an asset is impairment, what the carrying amount exceeds. Okay. What is the carrying amount? Assume carrying amount is nothing but the amount as shown in the financial statement of financial position after depreciation. Net asset value. Is it right? Net asset. How much is the assume carrying amount is $20,000. Okay. Amount exceeds the recoverable amount. How much is the recoverable amount? Recoverable amount exceeds means recoverable amount will be less. Okay. Recoverable amount will be less and is higher than the and the recoverable amount is higher than the fair value. Okay, recoverable amount is higher than the fair value. Assume fair value is going to be 15,000. Fine. Or disposal and its value in use. Fine. Now, what is the impairment? See the thing. This is where it says. The first option says that 20,000 is the carrying amount, recoverable amount is 18,000, and the fair value is how much? fair value is how much? 15,000. Okay. Now what happens here? It's a loss, is that how much is getting your fair value is recoverable? How much is the impairment? Impairment is how much? Impairment is going to be $2,000. Fine. Now next, very clearly put the things very clear perspective. The second one, what it is, an asset is impaired when the recoverable amount exceeds carrying amount. See, recoverable amount is how much? See, recoverable amount, assume recoverable amount is 18,000. Same value, is it right? Exceeds carrying amount. It's not exceeding carrying amount. Fine. It's not exceeding. Recoverable amount is assume 28,000. Fine. Recoverable. Carrying amount is how much? Carrying amount is 20,000. Fine. You are recovering more than carrying amount. Fine. You are recovering more than the carrying amount. It is not a impairment. Is that? It is not a impairment. The first condition automatically it is. An asset is impaired when the recoverable amount exceeds carrying amount. Again the same. The recoverable amount is 20,000, exceeds carrying amount, and the recoverable. The first condition you see, okay. The first condition you see, recoverable amount is more than the carrying amount. Finally, ultimately that condition will not satisfy. An asset is impaired when the carrying amount exceeds recoverable amount, and recoverable amount is lower than the fair value. Okay. Now, carrying amount is how much? Carrying amount is 20,000. Fine. Recoverable amount exceeds recoverable amount. Fine. Recoverable amount is 18,000. But recoverable amount is lower than the fair value. Fair value is more. Assume that fair value is how much? Fair value is 19,000. Assume fair value is less cost of disposal value. Automatically what will happen? These two conditions are not satisfied. Okay. These two conditions are not. Means it is also not. The answer is what? The answer is this one. Okay? This is the example. Okay, fine. This is the example with numbers. Whatever we are doing, we have to do with numbers. Then only it makes sense. Okay. Next, what is there? Fine. Prior to considering any impairment, what is the carrying amount of telepath plant and the balance on the revaluation surplus? Fine. We will do this. Okay. What is the this is related to this one. Okay. Now, what is the plant value as on? Just go back to the scenario. We can understand more clearly. When they have purchased on October 1st, 2010. Okay. Plant value was on 1/10/2000. Okay. How much is there? 750,000. How many years has been a years? 1 minute. When they are making a point of just go through bracket and when it is used for pharmaceutical, the plant cost 750 October. As on that, the estimated life is how much? 5 years. The review a plant on 1st April 2003. Okay, means the plant cost and that an estimated useful life is how much? 5 years. Life is how much? Life is 5 years. On 1st April, okay, the 1st April 2003. Fine. How many years are happened? See the things. 1/10/2000 to 1/10 30th September 2010. Level 1 equal to 1 year. From 1/10/2001 to 30th September 2002, it is going to be 2 years. And from 30th 1/10/2000 2 to 1st of April 2003 is how many? 6 months. That you have to calculate depreciation, is it? You have to calculate depreciation. Depreciation for how many years? 2.5, 750, 750, 750 divided by 2.5 years, it comes to how much? 375. It comes to how much? 375. It comes to how much? 375. How much is the carrying amount? Carrying amount is how much? Carrying amount is 375. Okay, 375. Fine. Carrying amount is how much? 375. Now they have done revaluation. Okay, they have done how much? Revaluation. How much is the revaluation? Revaluation is when they have done revaluation on first April. Okay, 1st April 2003. How much is there? 560. What is the revised life? How much is there? 3.5 years. Is it? Depreciation is how much? 560 divided by 3.5 years. Is it right? It comes to how much? 160,000 per year. Here 6 months depreciation. How much? 6 month depreciation will be 160 into 6 by 12 months. Okay, it comes to how much? 80,000. It comes to how much? 80,000. Now what is the revised carrying amount? Okay, revised carrying amount. Okay, revised carrying amount is nothing but revalued amount. Revalued amount is how much? 560. Okay, till this is on 1st of April. Okay, 1st of April. Depreciation for 6 months. Okay, next 6 months. Okay, how much is the depreciation? 80,000. Yeah, we have taken here for already we have taken it for 2.5 years. Is it right? We have taken it for, means it is by 30th September. It will be for 3 years. Okay, it will be for 3 years. So how much we'll get? It comes to 480,000. Okay, 480,000. Fine. Now what they say? How much the planned? This is the planned carrying amount. How much is there? 480,000. You have 480,000. Is that two are there? Point A and point. Now what they are asking you? They are asking you revaluation surplus. Revaluation surplus. How much is the revaluation surplus? Revalued amount. Is that revalued amount? Revalued amount is how much? Revalued amount is 560. Okay, and carrying amount. Is it? Carrying amount is how much? Carrying amount. Is it right? As on 1/4/2003. 1/4/2003. Okay, is it? That is the depreciation after this one. Is it? This is the one. Okay, how much is there? 375. Is it? How much is there? 375. How much it will come? 560 minus 375. It comes to 185. This is revaluation surplus. This is answer is what? Answer is 480 and 3 this one. Okay. Now, what is the value of plan as on 30th September 2003? Okay, 30th September 2003. What is the carrying amount? What is the value in use? Okay, what is the value in use? We have to take particulars. Is it right? We have to take particulars. Put dash here. Okay, put one dash here. Particulars. You have the cash flow. You have the cash flow. You have the discount factor at 10%. Is it right? You have the present values. Is it? Particulars is what they are talking about. 30th September 2004. 30th September 2005. Yeah, 30th September 2006. How we got it? Just go back to this. Is it? Just we have to see the scenario. They say that as a result, revised is estimate that net cash flows earned from the plan for the next 3 years would be how much? 220, 180, and 200. And what is the cost of capital at the rate of 10%? 0.9 discount factors. Is that they gave the corresponding years with corresponding discount factors. Okay. If you convert it into the present value, that is nothing but the value in use. Okay, that is nothing but the value in use. How much is there? 220. 220. It is in thousands. Is it right? It is in thousands. Yes. 220. 220. It is in thousands. Fine. Okay. It is in thousands. Now 220 is there, then how much is there? It is 180 and it is 200. Okay. What is the discount factor? 0.91, 0.91, 0.83 and 0.75. Multiply this. Okay. This is column 1, this is column 2, this is column 3, this is column 4. Column 4 equal to 2 times 3. Okay. Column 4 is 2 times 3. How much you will get? You will get here 200.2, 149.4. Cross check my calculations. Okay. You have to do literally. You have to do literally. Then only it makes sense. Okay. Then only it makes sense. How much is there? 9 and 1, 2, 3, 4. 499.6. in thousands. Okay, or 499,600. Fine. Next, which of the following, see, that is what it says in the section B. They will ask you concepts, they will ask you applications on specific topics, on standards, especially on standards. We have to be thorough with the standards. Okay. Which of the following are true in accordance with IAS 36? Impairment of a cash generated unit is the smallest identified. What is the definition of cash generated units? Is it right? This is where we are talking about what is the definition of cash generated unit. What is the definition of cash generated? A cash generated unit is the smallest identifiable group of assets for which individual cash flows can be identified and measured. This is the basic definition. It is the smallest identifiable group. Okay, that is the cash gen. When considering the impairment of cash generated unit, the calculation of the carrying amount and recoverable amount does not need to be based on exactly the same. No, it should be on the same group of assets. Is it? We cannot mismatch it. We cannot. When it is not possible to calculate the recoverable of one single, then the cash generated unit should be measured instead. Is it right? Means if it is not going to on a single asset, then what is that? We have to think about cash generated unit should be measured instead. The answer is what? The answer is 1 and 3. Okay, the answer is what? 1 and 3. Next, What is the carrying amount of the Relda's plant after impairment? Fine. What is the cash? Now this is with respect to the cash generated units in terms of the after the impairment of loss. Okay. See the thing may be very specific. We are covering the complete. How much is the see? Telepart also owns Relda 100%, which is treated as a CGU. 30th September, there was an impairment of assets 3.5. The carrying amount of assets immediately before the impairment was like this, and we have to think of first what will happen. Goodwill will go. See, goodwill will be written off. The current assets value will remain same. These are the basic 1, 2, 3 points. Okay, the goodwill will be written off. The current assets value will remain same, and the rest of the assets you have to proportionate it on the weighted average basis. Okay, weighted basis. Now what is there is that this is a very comprehensive one. Okay, this is the comprehensive one. Particulars, you have the cash flow. Is right? You have the cash flow. You 1 minute. 1 minute. Particulars, you have the carrying amount before impairment. Is it right? Carrying amount before, and you have the impairment loss. Is it right? You have the impairment loss, and you have the carrying amount after. Is it carrying amount? Very interesting. You covered these things. Hopefully, you will. Goodwill. Goodwill is there. What are the things we have? We have goodwill, factory buildings, plant, receivables. Okay, goodwill, factory buildings, plant and receivables. Okay, plant. My handwriting is not that much. Okay, but this is what the thing. I want you to make sure that you are attending a real class. It's a virtual. Don't think that it's a virtual class. It's a real class. That is the reason I'm not typing it. Okay, and please subscribe to this channel. Very important. And wait for the financial management and advanced financial management. I will come up with very sequentially in order. Okay, goodwill is how much? Goodwill is 2000s. How much is there? Just go through it. How much is there? 2000 for 2 million, 4 million, 3.5, 2.5, 2, 4, 3.5, 2.5. Okay, this is in thousands. Okay, this is in thousands. 2, 4, 3.5. Is it 3.5 and 2.5? Impairment loss. Straight away, is it? Straight away, what will happen? Straight away, the goodwill will be written off. Okay, goodwill will be written off straight away. How much is the impairment loss? Impairment loss is 3.5. Is it right? Impairment loss is 3.5, and receivables will not be there. Is it right? We cannot take current assets. The carrying amount will be how much? 2.5. Okay, this now. What is the amount of these two? This is the one. Okay, this is the one. Now what we have to do? We have to distribute 3.5 into this one. Okay, how much is the total? If you take the total of this, it comes to how much? It comes to 7.5. Okay, now what is the factory building? Is it factory building is how much? 4,000 divided by 7.5 into 3.5. It comes to how much? It comes to 800. Okay, it comes to how much? It comes to 800. And what about this? 3,500 divided by 7,500 into 3,500. Is it right? 35 divided by 75 into 35. 3,500 divided by 7,500 times fine. One. Here what we have to do? Here we have to see. Here we have to take how much? See, it is not so. Okay, fine. How much is the amount? Total is how much? 3,500 minus 2,000. It comes to how much? 1,500. 1,500 we have to do. Is it right? Now what will happen? Sorry, I have 4,000 divided by 7,500 times 1,500. It comes to how much? 8 years. It comes to how much? For 1,500. Okay, 1,000. It comes to how much? 700. Fine. Now it comes to the total is 3,500. The total is 3,500. Now what is there? This is column 1, this is column 2, this is column 3, this is column 4. Column 4 is 2 minus 3. Okay, 2 minus 3. It comes to how much? It comes to 3,200 and 2,800. Fine. 2,800. Total comes to 0,051 678 8,500. Where is that? $8,500. What they are asking us? What is the value of plant? Okay, what is the value of plant? What is the value of plant? Value of the plant is how much? Value of the plant is 2,800. The value of the plant is 2,800. This is the scenario 1, scenario based questions. Okay, what we have done in the IS 36 we have done IS 36 and we have done with respect to impairment of assets. Fine. This exclusively, see, you cover this automatically. We have covered the concepts as well as calculation. And next, at the following scenario 21 to 25. At the board meeting in June 2002, Neutron directors made the decision to close down one of the factories by 30th fine and market both the building and plant for sale. The decision has been made public and was communicated to all affected parties and fully implemented by THAI. The directors have provided the following information. Whether 250 employees are there, 50 will be retrained and deployed. Okay, 50 will be retrained and deployed, and the rest will be within the Neutron group during the year 30th at the cost of how much? 125. The remaining I will accept redundancy at how much? Means how many employees? 200 employees will accept the redundancy. The plant has a carrying amount of 2.2. It can be sold for 500,000, with how much selling cost? 50,000. Means carrying amount minus the realizable value. Within that, any selling expenses we have to deduct it. Okay. The factory has itself expected to sell at a profit of 1.2. The company has rented a number of machines in the factory under short-term leases, which has an average 3 months after the 30th September. Fine. The present value of these lease payments are 1 million. The lessor has stated that it will accept 850. If we are paying immediate settlement, it will be how much? It will be 850. Penalty payments, if we have penalty payments to be estimated at 200, 50% of which is expected to be recovered from the insurers. To be recovered, okay, which is expected to be recovered. Is it? Uncertainty is there. Is it? These words has to be carefully understood. Identify. This is where we are talking in terms of IFRS 5. Okay, IFRS 5, discontinued operations. In the previous case, we are talking about the impairment. Now we are talking about the non-current assets held for sale. Identify by selecting a box whether the following statements are required or not if the operation is to be classified as a discontinued operation. So what are the things it is required? Again, we have to be thorough with IFRS 5. Okay, almost if you are doing this section, you will have a complete revision of IFRS 5. The operation represents a separate major line of business or geographical area. It is a separate line of business. Is that what they say? Following statements are required or not required. Is that the operations represents a separate major line of business. It is, when we are saying it is operations represent, means definitely it is a separate line of business or a job. The operation is a subsidiary. Fine. What it's IFRS now held for sale and discontinued operations. It is not a subsidiary. Okay, it is not a subsidiary. The operations has been sold or is held for sale. This we have to make sure that it should be held for sale next 12 months. Is it? Next 12 months. That is what it is required. That is what it is required. The operations is considered not to be capable of making future profits following a period of losses. Right? Following the period of losses, the operation is considered not to be capable of making future profit. Is that? See, this is not the condition with respect to IFRS as such. Be very clear about the rules of IFRS with respect. This entirely it is given in my lecture notes. Conceptual lectures are there. In that it has been clearly defined. IFRS 5 non-current asset. You refer this section, automatically you are well versed with IFRS. Okay, you are well versed with IFRS 5. Okay, that's what. Prescribe the recognition criteria for non-current assets held for sale. For an asset or disposable group to be classified as an held for asset, the sale must be highly probable. Yes, it has to means you have to define which of the following must apply for the sale considered highly probable. The buyer must have been located. No. We should not say that the must. There is nothing that we cannot see. You are decided to sell. It is not must be located. Fine. The asset must be marketed. You are marketing. Is it right? You should have at a reasonable price. Fine. The asset should be. Is it? The asset should be marketed reasonable. Management must be committed to plan to sell the asset. Is it? The management commitment has to be there that we are going to sell. The asset must be expected to take place within, it is 12 months. Answer is 2 and 3. Okay? Hopefully you all are understanding. Again, I will say, please subscribe to the channel. If you find really interesting and understanding the things, like the channel and share this channel with the people, students who are appearing for ACCA exams. Okay, that's why I say first subscribe it, share it and like it. Okay, and any comments just post in the comment section. It will be very helpful for us. Next, what is an employee cost with the closure and sale of neuron factory, which charge should be to profit and loss account for the year ended? How many, see what happening, how many people what they are saying that, see the thing, the factory has a recurring amount, you find the company rented, payments are due to non-completion of contracts, where we say we have said this, is it? This is this one. Fine. This is related to which question? This is related to question number 23. Okay. This is related to question number 23. Is it? Out of the 250 employees will be 50 will be retrained and deployed to other subsidiaries. And what is the cost? Nitron Group is at the cost of 125. The remainder accepted redundancy at the rate of 5,000 each. Is it right? They have the means you have to calculate. Is it? You have to see what happens. This is the future cost. Is it right? The cost of 50 employees is the future cost. Yeah, this is the future. How much is the? We have to calculate redundancy cost. How much is the? How much is the redundancy cost? How many employees are there? 200 employees at the rate of 1,000. It comes to how much? 1, 2, 3, 4, 5, 2. Is it? 1, 2, 3, 4, 5, 2. Now, what is the condition they have mentioned? Is it? What is the condition they mentioned? The remainder accept returns is at the 500. Fine. Next. $5,000 into 200. Okay. 5,000. This is not one. This is 5,000. Okay. 5,000 into 200. 5,000 into 200. It comes to how much? It comes to 1, 2, 3, 4, 5. 1, 2, 3, 4, 5 and 1. It comes to how much? What is the profit or loss on discontinued operation relating to property, plant and equipment? Okay, what is the? How much is there? What is the? What they are mentioned here? They are going to. This is with respect to which question? Question number 24. Okay, question number 24. Is it? This is with respect to question number 24. They have a carrying amount of 2.2. They are selling to 50,000. Recurring cost is 15. Selling cost is 50,000. What is the profit? To sell a profit of 1.2. Fine. Now, how much is there? 1 minute. How much is there? Carrying amount is how much? Carrying amount is how much? 2.2. Okay, 2.2 million. Fine. Carrying amount is 2.2. Next. Next. Carrying amount is 2.2 and expected to sell is how much? Expected to sell is how much? Expected to sell is 500,000. Okay. Selling expenses are how much? Selling expenses are 50,000. Is it right? Or it comes to how much? It comes to 0.45. Okay. It comes to how much? 0.45. 2.2 minus 0.45. Is it right? It comes to how much? 1,750. 1.750 or it is in million or 1,750,000. Is it right? It is a loss. No. In respect of lease and penalty payments, what is the provision required in the final? Question number 25. Is that question number 25? This is related to question number 25. Yeah, it is related to question number. This is also related to question number 25. Okay. Related. How much is there? The present value of lease payments is 30th September is 1 million. However, the lessor is stated that they will accept 850 if paid on full settlement. If non-compliance, how much is there? It is going to be 200,000. Okay. Non-penalty payments is going to be how much? 850,000 plus 200,000. Is it right? NRS payments. Where is that? Yes. Settlement amount is how much? Settlement amount is how much? Settlement amount is 850,000. Is it right? Plus add penalty payments are how much? Penalty payments are 200,000. Okay. Total it comes to 1050. What they are saying in respect of lease and penalty payments plus. Okay. What provision is required in the statement of balance sheet? As on that, how much we have to make a provision? We have to make a provision of 1,050. Okay, 1,050. Okay, this is what? This is the with respect to IFRS 5. Okay, in the previous case we have done with respect to IAS 36 impairment. One is on the standards, one is on the reporting. Okay, one is on the reporting. Good. Next, what they say, this is another one. Okay, the following scenario is 26 to 30. Speculate companies preparing financial statements for the year end. The following are relevant. They are talking about financial assets. Shareholding A is how much? It is a long-term investment in 10,000 of the equity shares of another company. These requires are acquired on 2002 at what case? 3.5. Transaction cost is 1% of the purchase price were incurred. On 30th September 2003, the value is 4.5. Okay. Shareholder B, a short-term speculative investment in 2000 equities. This is speculative. Okay. This is long-term. You have to differentiate. It. Is that? Short-term means marketable securities. Similar to that. These shares are acquired on 2002 at the cost of 2.5. Say 1% purchase price, transaction cost. How much is there? The value has increased to 3. Where possible, speculate, make an irrecoverable election. This is the most important word. Irrecoverable election for the fair value movements on financial to be reported in OCI. Okay, fine, we'll take that. Next, taxation. The existing debit balance is how much? 2.4. There is under provision of the liability is there. A provision of 28 million is required for income tax ended. This is the provision. This is the debit balance. The existing credit balance is how much? 2.5. And the provision is required is how much? Why mine? So there are so many things are required. Okay. We will see the question. What the question is requirement is there. Revenue, speculate sold one of the products for 10 million. As a part of them, speculate is committed to ongoing service of the products units 30th September in 3 years of the sale. See, when they have this is 1st October, this is 30th September. Fine. Dates are very important. The sale value is included in the selling price. The estimated cost of speculate is this much, and the speculate gross profit of this margin is how much? 25%. Again, just I am coming back. They have given in on the 1st October 2002 and and there has been until 2005. Okay, fine. Now, which of the following meet the definition of financial assets? See, again, here we are covering what? IFRS 9. Yeah? Automatically, the moment you covered this section, you are covering almost the basic concepts of IFRS 9. Okay, what the IFRS 9 says, I have again posted IFRS 9. Okay, please go through that. IFRS 9 says that an equity instrument, what is the asset? It is the equity instrument for another entity. Is it right? A contract to exchange instrument with another entity under conditions which are potentially favorable. Then only it is identifies a financial asset. A contract to exchange financial instrument with another under conditions. This is not. This is what? This is the. If you take this thing, is it right? If you take this thing, this is a financial liability. This is the financial liability. Cash is a financial. Answer is 1, 3, and 4. Okay, 1, 2, and 4. Sorry. Answer is what? Answer is sorry. 1, 2, and 4. Okay. Answer is what? Sorry. Okay. Now you see it's very now using the pull down approach, which is the correct amount to be included in the OCI with respect to financial assets. Okay, with respect to financial assets. First, you see see what is that financial asset? Is it? When you're saying that, what we say, these are the financial assets. Is it right? These are the financial assets. How much we have to include as a is fine. What is the conditions of financial assets? It has been mentioned. It has to be an equity. It has to be under favorable conditions, and it should be in the form of cash. Okay. Is that what it says? See the thing. This is not in terms. See, a long-term investment. Is that the offered equity shares of another company? How much is that? 3.5, and it comes to how much? It comes to, it has been increased to how much? It has been increased to, it is not for trading. Okay, it is not for trading, whereas this is for trading purpose. Where is that? It is short term. Okay, it is for trading purpose. You have to make a irrevocable election. Is it irrevocable election? When we are saying irrevocable means we are not going to change. Is it right? We are not going to change. He is a short term investment. Is it? Whereas the first one is. This is long term. Is it? In this case, how much they have? See, it is how much? It is not held for trading. Is it? As an election. Okay, as an election made. Fine. It is not. We are making very specific. Whereas this is held for trading. This is held for trade. Now what happened? Automatically this will not be considered. Is that this is how much they have bought shares. They have bought shares are how much? 10,000 into 3 point. Whichever is held not for trading, that has to be selected. Okay, that is the precondition. Okay. 10th, how much they have said? They have said 10,000. How much it will come? It will come to how much? 335,000. What is the transaction cost? They have said transaction cost is 1%. Is it? Transaction cost is 1%. How much is there? 355 into 0.01. Okay. Plus transaction cost is how much? Transaction cost is 1%. Is it? How much? 350. Is it? How much will come? 350. It comes to how much? 35,350. Is it? Next. When it is there, this happens when this happens on 1st October 2002. Is it? And 30th September 2003, after 1 year, 10,000s into 4.5, you can put like this, 1.1. Is it? Transaction cost. Is it? Transaction cost is how much? 1 minute. Is it? 1 minute. How much is it? It is how much? 4.5. It comes to how much? 45,000. Fine. What is the gain they are having? Gain is how much? 45,000 minus 35,350. Is it? 45,000, 35,350. It comes to how much? It comes to 9,650. It comes to how much? It comes to 9,650. See, I will again write here. Is it? 10,000 into 3.5 into transaction cost of 10%. Is right? 35,350. This is the as on 1/10/2002. Is it? 30th September 2003. 10,000 into 4.5. Okay. It comes to how much? 45,000. Gain is how much? Gain is 45,000 minus 35,350. It comes to 9,650. Fine. Now, what is the total amount to be charged in statement of profit and loss account in respect of taxation? Fine. How much is the taxation? Be clear about this. Little bit. Is that they have the debit balance of 2.4. Is it right? They have the under provision or over provision. A provision of 28 million is required for the taxation, and the existing credit balance is how much? 2.5 million, and provision is how much? 4.4 million. Okay, that's very simple. Now, just I am going in slowly. I will do it. Okay, very slowly. Is it deferred tax provision? Is it deferred tax provision are required? Is it required when 30th September? Okay, 30th September 2003. How much we need? 4.4. Is it right? This is in thousands. Okay, this is in thousands. Fine. Now, how much is the deferred tax provision as on 1/1/10/2002? Already they have provision of 2,500. Okay, 1,900. Now, how much they have been under provision? They say that under provision is how much for the year ended? For year ended is 2000. 2002 is how much? 2004. We have to make additional provision. Is it? Next, charge for the year. How much? Charge for the year. Is it? Charge for the year 30th September 2003. Is it? Charge for that. How much is there? 28,000. Fine. 0, 0, 3, 1, 1, 10, 11, 12, 1, 22, 32, 300. Okay, 32, 300, 3 zeros. Yeah, 32, 300, 3 zeros. Fine. You have to be little bit slowly, we have to work it out, right? Next, what is the amount of deferred income which has been recognized in the financial statements, okay, for the contract? Yeah, they have given something on the revenue. See the things, how much is they have a sold products of 10 million. Speculate company is ongoing service for the product of 30th September 2005. The sale value has been included as 10 million. The estimated cost is 600 per annum, and speculate company gross profit is 25%. See 1/10/2002. We are preparing on 30th September 2003. The contract is till 30th September 2005. Okay, means of how much is there? 3, 4, 5. This is for 5 years. This is for how many years? This is for 3 years. Already this is for 1 year, is it? And this is for 2 years. Already 1 year is gone. We have to take only for the 1 year as such. Okay, how much is there? Yearly per annum is how much? 600. 25% is the profit. Okay, 25% is the gross profit margin. Fine. Now, when 25% is the gross profit margin, is that 25% is the gross profit margin? How we have to work it out? If 75% is equal to 600,000, is it right? If 75%, 100% is question mark. The difference is 25%. Okay, 100 divided by 75 times 600. It comes to how much? It comes to 800. This is the price includes profit. Is it? It includes what? It includes 25% profit. 100 divided by 75 into 600. Okay. Now, fine. What we have to take? This is for 1 year. Is it? This is for 1 year. What they say? What is the deferred income? Okay, deferred income should recognize. Now, deferred income is this is for fine. Now should be recognized. This income is for what? This income is for 1 year. Okay, this is for 1 year. Now already 1 year is over. Okay, we have to deferred income for what? Deferred income for rest of 2 years. Is it right? Rest of 2 years means from where 1/10/2003 to 2/39/2005. Okay, for 2 years. How much is there? 800 in times 2 years. Is it right? It comes to how much? 16000 or 1.6 million. Okay, 1.6 million. Which of the following are true in respect of income which speculate has deferred till 30th September 2003? The deferred income will be split evenly. Yes, they will split. What we are splitting it. Is it right? What happens in the first year? That we have how much is there? 600. Is it right? Per annum. Is that we are taken what? We are taken it for next 2 years. Is that next 2 years? We are splitting it into current and non-current liabilities. Is it? We are splitting. We are dividing it. Okay, we are dividing. The cost associated with deferred income should be recognized in the statement of profit. Same time, Is it right? We have to means when it is happening. It's nothing now. You can say it is going to be a matching concept. Okay, it is going to be a matching concept. Is it? It is going to be. We can say it is going to be an accrual concept. Okay, we are talking about the accrual concept. Right. Next, the deferred and can only be recognized as revenue, but when there is nothing like that signed agreement. Okay, there is nothing like signed agreement, written contract. When recognizing the revenue associated with the service contract, the stage of complement, no, it is relevant. Answer is what? Answer is A and B. Okay. Hopefully it's clear, is it? This is about the section B of financial reporting. There will be 3 different scenarios. For each scenario there will be, see what we have done. We have done with IAS 36. We have done with IAS 36. Is it? We have done with IAS 36 impairment of assets. We have done IFRS 9 financial instruments. Is it? We have done IFRS and we have done with 3 different scenarios with respect to financial assets, IFRS 9. Is it? We have done with respect to 3 different, and we have taken into consideration the taxation also. Okay, we have taken that. Now this is the way that things has to be done in section B. Hopefully you got some idea with my explanation. I will come up with another video of section C. Section C I will divide into 2 things. One question I will do in one session. There are 2 questions are there. I will do 1 question in each individually. Okay. So in the end, again I will say that hopefully you got some understanding on this. You got some understanding on section B, and I kindly request you to subscribe to this channel if hopefully you have liked it. If it is liked, you like it and share this channel. Okay, thank you so much. Best of luck.